In the early 2000s recession, the US economy faced a buffet of shocks. It faced a collapsed tech sector after people realised that the Netscape Navigator may not be a viable investment. It faced a geopolitical crisis as the world woke up on September the 12th to a fundamentally changed world. And it faced a fundamental change in the level of tourism and flows between capital as a result of the SARS outbreak. But the reason the early 2000s recession never entered into our economic textbooks as a major event was because it wasn't a financial recession. What that meant was that the US Federal Reserve was able to reflate the economy using conventional monetary policy. Contrast that to what happened in 2008. Many people were fearful, believing seriously that we would go into another shock and another crisis of a magnitude not felt since the Great Depression. People feared that banks may collapse wholesale and there might not be the ability to give these banks bailouts. People feared that credit might not be released and all of our tools of monetary policy were gone as our interest rates had already plummeted to zero and we found ourselves pushing against a string. Clearly we need the ability to run monetary policy in order to stop financial crises, but that can only exist when we have greater control over the banking sector, and we can only gain that when we have a nationalised system. 2 points in this speech. First, I'm going to look at how we improve the operation of monetary policy. Secondly, I'm going to look at the efficiency of allocation of financial resources. First, to monetary policy. What we've heard from the CEO was that, but opening government were talking about like reducing interest rates in order to have politically popular things funded. Well, what we were talking about were two different interest rates in terms of what we believe should be happening within the market. The one is the reserve rate, which occurs within the central bank on reserves held by commercial banks. The other is the rate of lending that is actually given out to consumers in loans. While at the same time, the Federal Reserve and the interest rates held on reserves by central banks around the world plummeted to near zero, that was not reflected to the extent they should have been within the interest rates that were given to commercial and financial lending, to other normal individuals who are the key link between what happens on Wall Street and what happens on Main Street. The result was there were people that the banks collectively decided that they were better to go through a process of deleveraging their own balance sheets rather than lending out the increased money that was created. So what that meant was that the US and many other economies around the world had to turn to unknown strategies that markets weren't able to predict the effects on. So while we can use quantitative easing, that results in huge inflation of assets around the economy, such as stocks and shares, and it works partly through stoking expectations of future inflation, which is also something which has welfare losses within the long term. So as a result, then we were using untested policy mechanisms when we could have used more conventional direct mechanisms by commanding banks by fiat, because you are the government, that they need to go out there and lend to businesses, that they need to drop the rates that apply to businesses, and as a result, restoke lending. And when people know that there is a systemic way the government is able to deal with even a very severe financial crisis, then people are going to be much more willing to go out there and spend. Because macroeconomics is just a coordination game. In one equilibrium, you spend a low amount and you expect your income to be a very low amount. In the other equilibrium, you spend a relatively high amount, and as a result, because your spending is someone else's income, on a macroeconomic sense, that results in a better result for everyone. What we need to do is convince people the government has the tools necessary to be able to get back to that equilibrium. So while the government was able to create huge amounts of money through measures like quantitative easing, very little of that flowed through to actual lending activity. So we can bridge that link by allowing banks to more directly be involved in that operation, no thank you. What did they say? They said, we're able to have some public banks who might be able to run this kind of monetary policy, make the link between monetary policy and lending, but we can also have private banks. Here are some reasons that doesn't work. Firstly, if there is a government bank which is lending out at interest rates which are cheaper than the private banks were, that would result in all of the effects we had as people would move over to the government bank and gain their loans at a lower interest rate. So our state bank would become incredibly powerful under our model and under what you're proposing, and the eventual result would be what we're supporting, a series of state banks who dominate that market entirely. We believe that would furthermore result in all of the anti-competitive and political effects that they talk about. Furthermore, at the point you're only lending through a particular bank, you don't sort out the interrelations that apply to the rest of the economy. because many people will be exposed to loans that have been given through private banks which can't be directly affected as a result of the fact the state has no control over those. Furthermore, because these banks are going to be systemically important, there are huge interlinkages within the financial industry, the state-owned banks would also be holding assets from the private banks. So unless you have some sort of mechanism to ensure that there's confidence in those private banks, then you have to plough a whole lot more into the bailout funds in order to ensure the state banks stay solvent, because of the fact that the assets that they're holding in private banks, which are hugely volatile, aren't going to be able to be believed in as having a credible price. Let's now look at the efficiency of allocation of this capital. So they wanted to talk a lot about the developing world, where most of the capital that comes through and most of the loans that come through saving, come through things like rotating credit and saving organisations within Rwanda, and come through within other smaller private organisations that don't have large systemic effects. The next thing we hear is that we're going to have reduced loans being given out to political parties, as if debt financing was the typical means by which a political party sustained itself. More often, and I'll take a PI if anyone has one now, what happens is that we get a result, really nothing, guys, weak.
Please deal with the fact that governments just manage banks worse. They manage their own banks worse, and therefore we would like to get more risk-taking, which is what you want to prevent on your side of the house, meaning more economic crisis on your side.
So, firstly, to the points of reduced efficiency of capital allocation, even if there is a cost to short-term economic growth during the good times, we're prepared to sacrifice that for the ability we gain to have long-term growth as a result of the fact we're able to stop financial recessions. So what that means is that we never enter into a protracted recession and people have much more confidence in the financial sector in general. Political parties and newspapers are more likely to be funded by groups such as relatively rich individuals who provide patronage for those organisations, rather than getting a loan from particular individuals. Furthermore, we still have the methods that are used in order to be able to gain access to financial resources, like the place where Goldman Sachs bankers do once they've done their 2 years of hell. They jump over to private equity or venture capital and earn a hell of a lot more. So we have all of the mechanisms of getting the highly innovative and important methods of funding, but without the methods that cause systematic financial risk that results in the collapse of the large economies and results in capital flows. Stop that. We solve the fundamental coordination problem, which has become incredibly difficult as the economies are on the zero lower bound. Very proud to propose.